Hey, welcome to YSR Shorts. What's an index fund? You know, everybody talks about index funds. Oh, it's an index fund. Oh, it's an index fund. I've got an index fund. And I'm not always sure when people say that they really understand what they're talking about. I remember watching on a Saturday afternoon, it was raining. It's got to be 20 years ago. I was watching some home remodeling show. It was probably 2008, 2009 when that was really hot is when it was. And this guy who was, oh my gosh, this guy was so arrogant. There was nothing else on TV. I'm like, oh, let's see. And every room he walks in, he's going to remodel the whole thing. It needs travertine. He must have said travertine in a half an hour show 180 times because he thought that was what was going to bring high dollars to this remodel, was he was going to put travertine on every surface. And that was it to make it worthwhile, because you could say travertine and people didn't know what it means. It's not that expensive, by the way. People don't know what it means, so they think it's going to be worth more. And I'm thinking, if you're building high end, they actually know what travertine is and they know what it means. But people say index funds, and boy, I think the same thing, that they're not quite sure. So I want to kind of go through the basics of what it really means so that you understand it. You go, oh, is that how that works? So what's an index? An index, we're talking about stock market indexes or indices, is the oldest, the most known, I guess, probably the most quoted over the last 100 years is the Dow Jones Industrial Average, or the Dow. That was created by Dow Jones. I will let you in on a secret. Dow Jones publishes the Wall Street Journal, which is why the Dow Jones Industrial Average still exists, because it is outdated. It is a dinosaur. It is 30 hand-picked companies by Dow Jones. They pick them once every couple of years. They'll reevaluate and say, do we have companies that are really representative? It's industrial. Originally, it was things like manufacturing. Not much. I mean, I think NVIDIA's in there. There's some manufacturing. There's a lot of tech in there. It's a question of what do we consider manufacturing? But it is a very simplistic 1800s level, and it was 1800s level when it was created, average of those stocks. So the difficulty there is it's 30 hand-picked stocks, and one stock might be trading for 10, and one stock might be trading for 200. Well, the moves on the $200 stock are going to influence, because it's a straight average, more than the $10 stock. And that creates a lot of problems as well for the index over time. A much more broad-based and representative index is the Standard & Poor's or S&P 500. And people don't quite always understand what that means. Standard & Poor's is a financial firm on Wall Street. They do a lot of rating and things like that of various investments. But they created this index close to 100 years ago called the Standard & Poor's 500. It's the 500 largest U.S. companies, and it's equally weighted. There's a complex thing of how they do it, but it's not weighted based on price. Is they try to make it fair across those 500 companies, and that allows not one company to drive that index in any place. It's representative because I looked this up this morning, and I was surprised at this number. Of the entire stock market in the U.S., the S&P 500 makes up 85% of all of it in terms of the dollars invested. That's massive. Now, there are other areas that are valuable investment options, but the large companies, the largest 500 companies in the U.S., hold 85% of the wealth of all of the traded companies, and I find that to be absolutely massive. But there are other indexes that you can follow. You can follow small companies or internationals and medium-sized companies. You can go to sectors like real estate or gold or something like that. You can get sectors within categories. You can get small companies related to mining, and you can find an index for that. You can get very detailed there. But all of those indexes allow you to understand what's going on within a certain segment of the economy, and there are stocks that are within that index that the firm that publishes it is designed around, so that we can then see what that category is doing. Well, an index fund or an index ETF or exchange traded fund basically looks up what those stocks are that are in that index and just buys them. So you actually own pretty close to the index. You're never perfect because there's buys and sells and things like that, but it allows you to purchase the index. But understanding what the index is allows us to make better investment choices, so that instead of trying to figure out what are the best U.S. stocks that I can invest in, you can look and say, I just want to buy the S&P 500. It's 85% of the US market. It buys all the big guys. It buys all the names I see in the newspaper every day. That's really what I want to look at. So that is how they work. Talk about advantages, disadvantages. The advantages, it's easy. It's a buy it and forget it. It's relatively cheap. There's no management fee on an index fund. I go back to the late 80s, early 90s when I got into this business, and most funds were actively managed. Most dollars inside of funds by a huge margin was actively managed. And those, a stock fund at that time might charge 1% or close to 1% per year to manage the investments. An index fund might be 0.01%. So moving the decimal place a whole bunch of places over. So a $10,000 investment, might pay $1 to manage that. They don't charge a lot because it's just trading costs. The computers are handling most of the heavy lifting. So it's very, very easy that way, and it's very inexpensive that way rather. And then it's very simple. It allows you to plug and play the various areas of the investment world that you want to focus on. Again, you can find an index fund or an index ETF for just about every index you would want to track. It allows you to plug and play. What's the disadvantage? Personally, in my experience, and this is my opinion, I find that once you get away from large categories like the S&P, the advantage that an index gives versus looking at other ways of investing may not be accurate. Again, it may not be a huge deal. I think it's a huge deal, but there is possibility of getting better performance without using that index in there. So I hope that kind of answers that question. If you have questions, jump down in the show notes, and I will see you next time. Stay safe out there.
Thank you for listening to our podcast. Remember, the views expressed are not necessarily those of Successful Money Strategies. All content is for educational purposes only and should not be construed as an endorsement of any third party or their views, or as a solicitation or offer to sell securities or provide investment, tax, legal, or consulting services. We believe the information presented to be reliable, but it is not guaranteed for accuracy or completeness. Investing involves risk, including the potential loss of principal. Hypothetical returns do not reflect actual trading and may not be indicative of the performance of any specific investment. Always consult with a qualified financial advisor before making any investment decisions. Past performance is not a guarantee of future results. Additional information, including management fees and expenses, is provided on our Form ADV Part 2, available upon request, or at the SEC's Investment Advisor Public Disclosure website, https://advisorinfo.sec.gov.